Hi, good day everyone, forever you are watching from. So today is going to be the concluding part of our straight line method calculation. In the previous class, we look at the meaning of depreciation, we look at the causes, and we look at methods. So we started with straight line method and we look at the formula, which is cost minus scrap value over a number of years. At times another textbook can say useful life or estimated useful life, so it's still the same thing. Then we take an example whereby we calculated the rate of depreciation for each year, and then we have our depreciation schedule too. Now when they give a question like this, it doesn't end here. We have two methods though, and I'll be explaining the two methods. We have old method whereby you'll be asked to prepare the asset account. After you have prepared your depreciation schedule and calculated your depreciation rate, you'll be asked to prepare the asset account just as anyhow it is stated in the question. Will depend on the method that you are going to use, but under the old method you are going to be, after you have prepared your depreciation schedule, which is optional, you are going to prepare asset account, you are going to prepare depreciation account, you are going to prepare profit and loss account and balance sheet extract. So after calculating the depreciation rate, you are going to be preparing those four accounts. You are going to prepare asset accounts. Your assets might be machine, might be plants and machinery, any asset. So you are going to prepare asset accounts, you are going to prepare depreciation accounts, you are going to prepare profit and loss accounts, then you are going to have your balance sheets extracts. That's for old method. But if it is for the new method, we are going to prepare your asset accounts too. Any asset they give you, you are going to prepare asset accounts. You are going to prepare provision for depreciation accounts. You are going to prepare your profit and loss accounts. And you are going to prepare balance sheet extracts too. So if you are to use the old method, these are the questions that they are going to ask on that. Once you see a question like this and they ask you to calculate the depreciation rate and to prepare asset accounts, depreciation accounts, profit and loss accounts, and balance sheets, that means you are using the old method. And when you see a question whereby they ask you to prepare the asset account, provision for depreciation accounts, and profit and loss account and balance sheets, you are using the new method. So now we are going to be going to the we are going to use the old method first. We are going to use the method first. So we are going to be preparing the asset account, and our asset according to this question is machine. So you are going to write machine accounts. So debits and then credit side. So you are going to prepare machine accounts. So now when preparing your machine account, the first thing that you're going to have at the debit side is, you can just use year one. Then your assets, when you bought it in cash, so you are going to write cash. Then the amount is 10,000 naira. Then you come to the credit side, so you write year one. So you write what is the depreciation rate for the year one? When in straight line method, it is the same depreciation rate for our number of years that they give you. So when we calculate our depreciation rate, we have 1,500. So you write depreciation, the amount 1,500. Then this is the only thing that you are going to post at both debit side and credit side. Now you realize that the debit side we have 10,000 and at the credit side we have 1,500 now. and in account the both side must be balanced. So you are going to deduct 1,500 naira that you have at the credit side from 10,000, and you are going to have 8,500. So you are going to write it as balance carried down. So 8,500. So you make it equal to both the debit side and the credit side. Then you close it. Then you move to year 2. You come to year 2, and your balance carried down that you have here, you bring it here, which will be balance brought down. So which is 8,500 naira. Then you come here to year 2. Your depreciation rate for year 2 is still 1,052. So if you deduct 1,005 from 8,000, you are going to have 7,000, and that will be your balance carried down. And you balance the both side of the account. Going forward, you come to year 3 again. Your balance carried down that you have at the credit side, you bring it to the debit side soon, which is 7,000 naira. So year 3 here at the credit side, so depreciation 1,500. Then if you deduct 1,500 from 7,000, you are going to have 5,500. So that will be a balance carried down, 5,500. Then you add it together. Then you bring the 7,000 down to, and you balance it. Then you come to year 4, which is the last year, because our asset used to be depreciated for 4 years. So your balance carried down that you have in year 3 at the credit side, you bring it here as balance breakdown, which is 5,500. Then year 4, our depreciation rate is still 1.5. So your balance carried down. Now if you deduct 1.5 from 5,500 that is here, you are going to have 4,000 naira. So you balance it. So you have your 5,500, 5,500. Now the next thing is to prepare our depreciation accounts, and in preparing our depreciation account, there's no much in it. Just that at the debit side, you are going to have your assets, you are going to post it with the depreciation rate amount, and at the credit side, you are going to write it as profit and loss with still the same depreciation rate amount. So here we go. Year 1, you write machine. Our asset is machine. So you record 1,500. You come to the credit side, year 1, profit and loss 1,500. So you do the same thing till the number of years that is in the question. According to this question, is just 4 years. So that's what you are going to do all through. So once you finish preparing, this is what you are going to have in your depreciation account. So now the next thing is our profit and loss account. Now for our profit and loss account, there's not much here too. We are just going to apply the principle of double entry, which says for every debit entry there must be a corresponding debit entry and vice versa. So in our depreciation account, you realize that our profit and loss is at the credit side. So when bringing it to our profit and loss account, our profit and loss in our depreciation account is at the credit side. So when bringing it to the profit and loss account, it will be at the debit side, and you are going to be recording it as depreciation, and it's going to, you only have business with the debit side. Now you don't have anything to do with this credit side. So it's going to be year 1, so depreciation 1,500, year 2, depreciation 1,500. So like that you get to the 4th year, or the number of years that you are given in the question. So this is what you are going to be at. Now if it, unlike reducing balance method, the depreciation for each year will be different. So even if you are using reducing balance method, your depreciation for each year is going to be different, but for straight line method is going to be the same. So now moving forward, we are now preparing our balance sheet extracts. So now in preparing our balance sheet extracts, in our balance sheet extract, so we don't have any business at this side of the account. It's only this side that we have business with. And what we are going to be doing we are going to do it according to the years too. Now for year one, we are going to write the name of our assets, which is machine. Then the amount of the assets when they bought it was 10,000 naira. Then we will now less our depreciation, which is 1,500. So when you deduct 1,500 from 10,000, you are going to have 8,500. Then you move to year two. Now for your year two, you are going to be bringing out this 8,500 is the net book value of that asset at the end of year one. So for year two, you're going to be bringing this 8,500 as the value of your machine. So 8,500. Then you less your depreciation too, which is 152. So at the end of year two, the value of the machine is 7,000. When you less 1,500 from 8,500, you are going to have 7,000. Then you move to year three too. Your assets, which is machine, the value as at the end of year two, which is 7,000, you bring it down here. Then you less your depreciation too, which is 1,500. When you deduct 1,500 from 7,000, you are going to have 5,500. Then you come down again to year four. That's the end. That is 4 years. So if it is more than 4 years, you continue. So you write your assets machine. Then 5,500, the value of the asset at the end of year three. Then you less your depreciation, which is 1,500. When you less 1,500 from 5,500, you are going to get 4,000. So at the end of the 4 years, the value of the machine has dropped to 4,000 naira. So that's the value of the machine as at year 4. That's the net book value. I hope this video is helpful. See you in next class again. Thank you for watching. God bless you.